Hello, my friends. Today is December 16th, and this is Markets Weekly. What a week, right? What a week. So, the headline act the past week was obviously the Jay Powell show. We've already discussed that. So, now we're going to talk about three other things that happened this week. First, let's talk about how a quote unquote Fed pivot is filtering through the markets and how it might impact the real economy. Secondly, now Jay Powell was without doubt the headline act this past week, but he wasn't the only one. We also got meetings from the ECB and the Bank of England. And it seems like everyone in the world is out hawking the Fed. Let's see what the other central banks said. And lastly, we got some new research from the Fed about excess savings. Now, many people have been pointing out that there might be some quote unquote excess pandemic era savings that have been supporting consumer spending. Let's talk about that concept, what the work says, and why I think the excess savings concept is complete nonsense. Okay, starting with the markets. So, heading into the Fed meeting, the markets were pricing in about four rate cuts next year. After the meeting, the market is pricing in about six rate cuts next year. Now, the way that the Fed influences markets is, of course, through interest rate policy. The Fed can adjust the overnight rate up or down, and of course, it can also use its balance sheet. Now, a lot of times, though, the market listens to the Fed and comes to its own conclusions. But of course, the core nexus, of course, is through interest rates, since that's the tool that the Fed has most control over. So, to see the reaction in the markets from the Fed meeting, we got to look at the bond market. Now, the 10-year yield absolutely crushed lower this past week, ending the week below 4%. When we think about yields, we can break it down into two components. One, of course, is the market's expectation of the path of policy over the next, say, 10 years. The other is a premium the market is asking to hold 10-year treasuries. Now, this crush lower is basically entirely in the expected path of policy. Market is very aggressive in pricing in future rate cuts, and so the 10-year yield fell significantly. And this really surprised me. I was not expecting the market to be so aggressive. I was thinking that the 10-year yield had bottomed, but it looks like the market had other ideas. Let's see how that plays out going forward. Now, the Fed, of course, most directly influences interest rates, but interest rates bleed into other assets as well, most notably equity markets. Now, when we look at equities, well, of course, everything surged higher. The Dow Jones made an all-time high, Nasdaq made an all-time high, and it looks like the S&P 500 is not far behind. You can think of this through a couple lenses. You can be a traditional CFA guy and say, well, interest rates were lower, thus when you discount earnings with a lower discount rate, you obviously end up with a higher net present value, and so equities are worth more. Or we can simply say that there's some kind of asset allocation thing going on. A lot of people are looking at bonds. Well, bonds, below 4%, not as attractive. Let me buy more stock. Or maybe I have a 60-40 portfolio. My bonds appreciated significantly, so I'm going to rebalance and buy some equities. In any case, not rocket science. Interest rates go down, equities go up. And it looks like as long as the market holds this pivot, it can continue. Now, the financial markets aspect of a dovish Fed is pretty easy. Let's talk about how this might feed into the real economy. Now, interest rates impact the real economy in an uneven way. Now, just think about what happened the past 2 years. Interest rates went up significantly, but at the same time, the economy continues to go above trend. Some sectors of the economy are sensitive to interest rates, and some are not. The ones that are sensitive are obviously those sectors that uh, borrow a lot of money. Now, what immediately comes to mind, of course, is housing. Now, when people buy a house, they usually take out a mortgage loan. Mortgage rates are high and they reached as high as 8% recently. Well, people can't afford to borrow a lot of money, so they don't have as much purchasing power. There's less demand for housing. Now, though, that interest rates have come lower, that could be a whole nother story. Now, historically speaking, mortgage rates are about, let's say, a 2% spread to the 10-year treasury yield. Now that the 10-year is below 4%, we could see mortgage rates with a 5% handle in the coming weeks. And that might fundamentally change the game because a lot of people have been on the sidelines wanting to buy a house, but not able to afford one with 8% mortgages. With a 5 handle, that could really reignite the housing market. And if you take a look at home builder stocks, you can see that many people are anticipating this. An index of home builders looks like it's taking off to the moon. Now, the strange thing that happened the past year is that even though mortgage rates have been high and housing transactions have been low, home prices have actually continued to increase on a national at a national level. So, with mortgage rates coming down sharply, we could really see this take off. Now, many people are looking at this, and some of them are quite skeptical. I've heard smart people say that, maybe with mortgage rates are lower, this might actually be bad for home prices. Why? Well, because a lot of people who wanted to sell because they want to move up, now they can finally sell. So, in fact, it will unlock a lot of supply. And this makes total sense. Um, when people buy a home, sometimes they sell their current home, so that will increase supply. But I'm thinking this impact might not be as strong this time around, though, because many people, well, they're locked into a 3% or even 2.5, 2.75% mortgage. When they buy a new home, they might not want to sell their old home because that mortgage is so valuable. So, for sure, some people will have to sell their home to get money to buy a new one, but I think a lot of people might want to just keep that old one and rent it out. So I think the impact will be of lower mortgage rates will increase demand more than supply, and so I think that still seems quite positive for home prices, and of course you see that in the home builder stock as well. Now, another really interest rate sensitive segment of the economy is autos. A lot of people buy cars with auto loans. Now, let's look at the stock of the one of the largest auto lenders, Ally Financial. It looks like the home builder stock, right? It looks like it's going to the moon because as rates come down, a lot of people will be able to, take out loans and buy cars again, and so that could be a boom for that sector. And one final sector that I look at is people highly levered companies. Now, a good proxy of this is high yield spreads. So that's the spread you have to pay if you are a heavily indebted company with a low credit rating over treasury securities. And you can see from this graph that high yield spreads basically plummeted after the Fed meeting. That's the market anticipating that as interest rates come lower, there's going to be less credit risk because these companies are probably going to be able, well, at least with a higher probability, be able to handle their interest rate payments. So, all in all, this is going to be a positive boost for the real economy and it's going to push back against recession fears. Again, recession is always coming. That's just like death and taxes. But lowering interest rates, it seems, is going to push that further back. Okay, now let's talk about what else happened in the central banking world. Again, as we all know, the Fed was perceived to be very dovish. But what about the other central banks? We also got a meeting from the ECB, the second most important central bank in the world. Is the ECB going to be like the Fed and pull a dovish pivot? Let's hear what Madame Lagarde has to say.
We did not discuss rate cuts at all. No discussion, no debate on this issue.
Well, it looks like they're not thinking about rate cuts. And they shouldn't be, right? Their inflation is still above target. And as Madame Lagarde mentioned, they wages still continue to increase. And so maybe they're not where they want to be yet. And they also made some very interesting remarks on their quantitative tightening program. They seem to be wanting to decouple their quantitative tightening program with their interest rate policy, which is also what the Fed seems to suggest as well, and which is what I will write about how the Fed's communications may have changed the QT timeline. I'll write about that on Monday. Now, in addition to the ECB, we also had a meeting from the Bank of England. Is the Bank of England, like the Fed, going to dovishly pivot? Well, they didn't have a press conference, so we didn't get a lot of color. But they did have a meeting and they did keep rates steady. In that meeting, though, there was a dissent. It was a 6-3 decision. Now, what do those three dissenters say? Did they want to have a dovish pivot, but just couldn't overpower everyone else? Well, actually, it looks like those three people who dissented wanted to hike rates. So no, the Bank of England is definitely not thinking about cutting rates. We also had some commentary from the Bank of Canada. Is Governor Macklem over there thinking about cutting rates? Well, let's listen to him.
We're not taking further increases off the table. If we need to do them, we will. We haven't yet been discussing rate cuts, and I expect what we will be discussing is more, how long do we need to stay? How long do rates need to stay elevated?
No, looks like he's not going to do a dovish pivot either. Now, this whole host of communication should not be surprising. Inflation continues to be above target for many of these guys, and so they want to hold rates constant. What's really the odd man out is the Fed, and that actually really surprised me. If you look at a chart of global growth, you'll notice that in the US, growth is strong, whereas in the Eurozone and Canada, growth is not that great, and it looks like they're falling into recession. So if anyone should be thinking of maybe cutting rates and being a bit dovish, it's these other central banks. And in addition to that, a lot of the people in those countries, they have floating rate mortgages and they're feeling a lot of pain. But things did not turn out the way I expected. And so it looks like it's the Fed that's going to be dovish. And that has tremendous impacts on currencies. Now, if you look at the US dollar index, you can see that, well, this past week, the past few weeks actually, the dollar has sold off aggressively. And you can see correspondingly, commodities like gold have been getting a bid. Now, to be clear, the Fed realized that the market is probably getting ahead of itself and sent out John Williams, president of the New York Fed, the third most important person in the Fed, to come and do some damage control in an interview with CNBC, trying to walk back the dovish comments. But if you just take a look at that interview, it's about 8 minutes. What seems obvious to me is that uh, President Williams seemed a bit nervous and was very obviously trying to get the market to price uh, out some rate cuts, but simply wasn't very successful. And if you listen, you'll see that, this guy is basically a dove pretending to be a hawk. So the market just didn't believe that. And I don't think there's much the Fed can do to walk it back. So I think they'll probably continue to try, but I don't think the market is going to buy it. So it's going to be very interesting going forward. Now, the last thing I want to talk about is quote unquote excess savings. So during the pandemic, of course, there was tremendous amounts of stimulus and a lot of people continued to make money. But because they were locked in their homes, they were not able to spend that money. This was actually especially true for upper income people who tend to spend their income on travel, experiences, and restaurants. So all that was closed during the pandemic. And so what happened was that people were saving a lot more money than they usually did. This was what people think of as quote unquote excess savings. Now, after the pandemic, when everyone was able to go out and shop, a lot of people were kind of surprised by how strong the economy was and continues to be. One way of trying to resolve that was to think about excess savings. The thinking was that, well, these guys, they saved up a lot of money during the pandemic, and so that extra savings continue to fuel their consumption. But watch out, because once those excess savings are done, well, that means that maybe the economy is going to take a downturn because people aren't going to be able to afford all that spending. Now, the way you calculate excess savings is kind of more art than science. Some people calculate it by, let's say, historically you're saving 6% of your income, so anything above that is excess savings. Some people calculate it based upon a level. Well, historically, the economy is saving, let's say, $50 billion a month, but anything above that is excess savings. Now, there's a lot of ways to calculate this, and more importantly, what's the time frame you use to calculate the baseline? Is that just the past few years, or is it the past few decades, and so forth? So people come up with very different excess savings calculations depending on their methodology. But regardless of what you use, though, you can bet that you can see that excess savings is basically coming down. So does that mean that the consumer is running out of gas? Well, I don't actually think so, because I think that the whole idea is complete nonsense. Now, let's think about it from a household perspective. Let's say you earn money and you spend money, and the difference between the two, you save. But the stuff that you save, though, sometimes it's just left in your bank account. And so you can think of that as, let's say I earned $1,000, spent 500, I have $500 in the bank account. That's my savings. But for most people, though, it's not just in a bank account. You use that $500 and you can buy stuff. Maybe you buy stock, maybe you buy crypto, maybe you save up and you buy that house that you always wanted. So when you're talking about savings, what you're really talking about is wealth. And wealth is a dynamic number, it changes. Let's say the quote unquote excess pandemic savings was, I don't know, spent on crypto, which many people did. Well, crypto prices have tanked and then gone to the moon. What if it was spent on stocks? Well, stock prices have gone to the moon. So when you're talking about excess wealth, quote unquote, that's actually gone up significantly. Now, recent Fed data shows that as of the third quarter of this year, wealth was, wealth was around all-time highs. But since then, as we can see, the stock market has gone higher, bonds have appreciated, and home prices continue to go higher. That means that people continue to have more and more wealth. So that wealth can continue to fuel spending. You can think of it as a boomer, sitting on $1 million house somewhere. Maybe he downsizes, buys a smaller house, and then uses the rest of the money to go on cruises and so forth. Or you can think about a crypto bro, bought Bitcoin. Now Bitcoin went up a lot. He has a lot more wealth he can spend. So that excess savings idea, I think, is not useful. You really got to think about wealth. Now, to be clear, there's a huge additional impact of this. Few people hold a lot of wealth, but you also have to note that a lot of the wealth appreciation is in housing, and 60% of the people in the US own homes, and that's going to affect their spending patterns as well. So I think that the wealth effect is broader now, and it's much more useful to think about excess wealth than it is excess savings. And I think with wealth high and job growth, excuse me, unemployment low and wages growth high, we could actually still continue to see the US economy chug along. All right, so that's all I prepared for this week. Thanks so much for tuning in. And of course, if you are interested in my latest thoughts, check me out at fedguy.com, or you can check out my courses at centralbanking101.com. Talk to you all soon.